Hello student, here's Jean-Pierre Muhire from Ultimate Traders Company Limited. Today we are going to run a new lessons about our Forex trading, online Forex trading. Let's meet after the intro. Welcome back to today's episode. We have covered a lot about the courses about the Forex beginners. Today we are going to run another important lessons which is very important for your trading career. But before we go to this lesson, let's do a quick recap about the lesson we learned in the previous, the last day lesson we have learned. In our last lessons, we have learned about the spreads. We have seen that the spread is the difference between the ask and bid price. We have been seen that this is what we call the transaction immediacy, and it allows the brokers to make their profit while doing the business. We have seen what is a bid, where we have seen that a bid is the price at which you sell the currency, and we have seen that ask is the price at which you can buy the currency pair. So these two prices, they are all quoted with by the Forex brokers, and as mentioned, it helps the brokers to make a profit while offering you the currencies to trade. And we have seen that the way they make it, they sell you the currency pairs at a higher price to what compared to what they paid to buy them, and you buy the currency. They sell you a currency pair at a small price compared to what they paid to buy it, and they pay you. You buy it from them at a higher price compared to what they bought the currency pair. And this difference between the spread and the ask price, it is what we call transaction immediacy. And we have seen how we do make money in Forex trading, and we have seen that we can make money by buying an asset or a currency pair or by selling it. And the only way we have seen that it was that if we see that a currency pair that the base currency will appreciate in value, we buy this currency pair, and if we say we notice that the base currency will depreciate against the quote currency, we sell the currency pair. That is what we have learned in our last course. And without delaying, let's go to the today lessons. In today's lessons, we are going to run what we call risk management. This is a very important lessons today, which you need to run very carefully, because if you remember from what we learned from the trading psychology, we have seen that the trend improper risk management, it is one of the major reasons which cause improper trading psychology. So let's now today go in deep about the risk management. But if you are new to our YouTube channel, please subscribe to our YouTube channel so that you will know when the new lesson is released. And if you find something valuable with our lessons, please hit the like button, share to your friends and the family so that they can also get the knowledge, this free knowledge about the online trading. Without delaying, let's see what is risk management. Risk management is just a refers to implementing a set of rules and measures to ensure any negative impact of Forex trading is manageable. You know, in Forex, even though it is precise, we are only speculative about the price movement. It is not all the time that the market will follow our technical analysis or the move we have predicted that the market will move in. Therefore, if the price of the market or any asset does not move in the direction you have been predicted before, it can cause you a huge loss of your money. Therefore, we need to protect ourselves by risking a small amount of money of our account, so that if things goes wrong, we can manage the impact, the negative impact which has been caused with this loss. So these rules we set and the measures to protect ourselves from this negative impact, it is really what we call risk management. In Forex, you can take higher risk or less risk. But you should know that the higher risk you take means that it is the higher loss you can encounter if a loss if things goes wrong. The most mistake traders make is to think about what they make in a trading by ignoring what they could lose if things goes wrong. That is opposite side. If you want to be a profitable trader and if you want to treat the Forex, online Forex trading as a business, you should consider, before you consider what you will gain from a Forex from any trade, you should consider first what you could lose if things goes wrong. We will see why you have to do this. Believe me, your stomach has to be smaller than your appetite, and that is what is going to help you in this career of online Forex trading. Risk management can include establishing the correct position size. These are things which we consider while doing the risk management. Risk management could include the correct position size, setting the stop loss, controlling your emotions when entering or exiting trading positions. If you can control these three major elements, the position size and the setting of stop loss on every trade you make, we will see in detail in the near future what is a setting stop loss, and by controlling your emotions, I ensure that you will be a profitable Forex trader in the long run. So why do we need to apply the proper risk management? The risk management, as I said, it should protect you from blowing your account. Let's make an example. Let's say you have an account you have an account of 3,000 US dollar, and every time you make, this is your account, and every time you make a trade, you risk, let's say, 40% of your account. To make things simple, let's make 50% of your account. So 50% of your account of over $3,000, it will be 15,000 US dollars. It means you can only, if you get a losing streak of only of 2 trades, your account will be $0. You will blow your account only after 2 losing trades. You see how very dangerous to risk more, to risk much on your trading. This is completely different to someone who's risking, let's say, 1%. 1%. His risk per trade, it will be only $30. You see, from this one, to blow up his account, it will require to lose 100 trades in a row, 100 trades in a row to lose all his money. And if you are really a good Forex trader, it is not possible. I cannot say that it is not zero, but if you are really a good trader, it is nearly impossible to lose 100 trade in a row. You can lose maybe 3, 4, 5 to 10, but not 100. Therefore, you see, if you risk less, you can stay in the market for a longer time, and the more chances you have to be profitable. But if you take high risk, of course, you can experience huge losses if things goes wrong compared to what you have been predicted. So that is the first advantage of applying the proper risk management. It will protect you from blowing your account. Number two, proper risk management will make you profitable in the long run. Let's make another example in order to make sure that you understand this, because it is the key of succeeding in Forex trading. Let's say take the same example of $3,000 US account, and you know the disadvantage of risk management, and you are risking only 101% of your account risk, which is $30 per trade. Let's say you make 100 trades. 100 trades. And in these trades, let's say 60 was win and 40 was loss. This clearly shows that you won 1,800 US dollar and you lost 1,200 $1,200. In total, if you make a month between these trades, you see that you will make a profit of 600. This is only 60 times 30, which was our risk, and this is 40 times 30, 40 losses times 30. That is how we got these numbers. You see, after 100 trades, you will make a profit of $600. And depending on which trader you are, these 100 trades, you can make them even in one day. If you are a scalper, you can make, let's say, in a month if you are a day trader. So you see, in the long run, if you focus on a small risk, even though you lose some trades, in the long run, you will make money. This is the second advantage of using a proper risk management. So here is a pro tip. We advise not to risk more than 3% of your total account if you want to be a profitable trader. We advise you to do not risk 3% of your account. And for beginners, we strongly urge to risk maximum 1% of our total account. We sometimes even use 0.5% of our total account to make sure that you become familiar with the trading skills and with trading platform. And if you find yourself profitable with the smaller risk, now you can increase your risk to 2%, 2.5%. But no matter how good you are in Forex, we do recommend to do not risk 3% because anything can happen in the market. Therefore, bear in mind that and make sure that whenever you press a trade, it will be at least in this range. And believe me, this will protect you from blowing your account. Now, let's go for position sizing. As you remember, we have seen that here that risk management refers to establishing a proper position sizing, setting a stop loss, and controlling your motions. I think we have covered the emotions, controlling the emotion of trading psychology. So setting stop loss, we will see it in the near future. And today, let's see about the position sizing in order to know in detail what it is. So position sizing, it's simply setting the correct amount of units you need to buy or to sell while trading a currency pair. This will reflect immediately the risk you want to take. You simply want to make sure that if things goes well, you will not lose more than you set for yourself as loss. This is simply what we call position sizing, and you will need some information to make a proper position sizing. Number one, it is your account balance or of equity. Number two will be the currency pair you are trading. Number three is the percentage of account you wish to risk per trade. If you remember well, this is all recommended to do not risk 1 to 3% of your account. And you will need also to know the stop loss in the pips which you will have, the stop loss in the pips which you want to have, and you will need to know the conversion currency pair exchange rate of the currency you want to trade. After having these informations, you will be able to make a proper position sizing for your trade. Let's make an example of how we do calculate the risk management, the proper size position size. The position size you have to trade, it will be equal to the amount you are risking over the stop loss times the value per pip. Remember, we have told you how to calculate the value per pips. If you do not remember, you can go to our website and remind yourself how to calculate it. And after you have these informations, you will be able to calculate your proper position size. Let's make an example to make to show that you understood well how this formula works. But believe me, you don't even need to know this mathematics. It's just to let you know how it is calculated, because with advanced tools and modern technology, we have the calculators for this position size, and without delaying, we will show you how we use these calculators. So let's say you have an account of $10,000 and you want to risk 1% for this trade. So it is clear that your risk will be $100, and you are trading GBP USD, which is trading at 1.3675. So if you remember well how to calculate the pips, we calculate the 4 decimals after the 4 decimals. So we don't even need to calculate this one. And you want to sell this because it is resistance, and you want to take a stop loss of 200 pips. So this is all of these are the data we need to calculate our position size. So and see how let's see the numbers and see how we can plug them in our formula. So the risk, as I said, the 1% of our risk is $100. And if you remember well, the GBP USD for standard, the lot size, the value per pip is nearly $10 per pip, and you want to risk 200 pips. So our position size will be, if you remember well, the risk, we want to take this 200 over, the stop loss is 200 pips, and the value per pip is $10, which will give us the position size of 0.05 standard lot size, or simply 5 micro lot size, because if you remember, 1 micro lot size equals to hundreds unity of base currency. Why do we need this, and how does it work? This clearly means that if you trade GBP USD with a 10,000 account with these 5 micro lots, and by setting a stop loss for 200 pips, the maximum amount of money you can lose, it is only $100, not more. And you see that in the long run, it will protect you to do not blow up your account. And that is how position sizing, it is very, very powerful. Without delaying, if you remember very well, I have said that you don't even need to do this mathematics by yourselves, because there are some position sizing calculator, and the most known one, it is MyFX book. It can be used to calculate your position. What to do is to go to www.myFX book, and then you go to Forex calculator, FX calculator here. You can see it here, the Forex calculator, it is here. And then you go to position sizing. You see there are many calculators here, but what we need here, it is the position size calculator. So your position calculator will open. And as we said, you need to know the currency pair you wanted to trade, which is here. And our currency pair was GBP USD. You can type in there or scroll down into GBP USD. If this the logo pop-ups there, you can say later. Then you can go to GBP USD. The account size was 10,000 and our risk was 1%. You plug it in here, and the stop loss was 200 pips. And all you have to do is to calculate this, to hit this calculate button. And as you see, you will have these numbers. You see that the maximum your risk will be only $100, and you are trading 5,000 units, which is 5 micro lots. And